Imagine waking up tomorrow to find that 1/5 of the world's seaborne oil supply has simply vanished. A critical global choke point slams shut, sending massive, uncontainable shockwaves through every financial market, every international supply chain, and eventually, straight into your very own wallet. But what if I told you that while the rest of the world was left standing in a chaotic, desperate line, one specific country was quietly handed a VIP pass to walk right on through? Welcome to the new macroeconomic reality. By mid-May, federal energy authorities officially confirmed what the markets had been dreading. The Strait of Hormuz, a narrow but absolutely vital maritime artery, had been effectively sealed off to commercial shipping following severe regional escalations that began in late February. To understand the sheer scale of this disruption, you have to realize that nearly 20% of all the oil that moves across the oceans globally is suddenly trapped behind a geopolitical wall. This isn't just a distant problem for foreign diplomats to solve. This is an immediate, catastrophic disruption to the very lifeblood of the global economy. And at the center of this chaos is something called the petrodollar. Think of the petrodollar like an exclusive global arcade where the world's most valuable prize, crude oil, can only be bought using the arcade's proprietary tokens, which are US dollars, forcing every single country to purchase those specific tokens first before they can even play the game. This system has governed international trade for decades. It keeps demand for the US dollar artificially high, which in turn keeps borrowing costs for Western nations relatively low. But when the physical oil stops flowing through the Strait of Hormuz, that entire financial loop begins to fracture. This line clearly shows a massive historic explosion in international crude prices, shooting straight up to an astonishing $118 a barrel by the end of March. Major development banks were sounding the alarm shortly after, noting that this aggressive leap from $72 just weeks prior was entirely driven by an extreme geopolitical risk premium, marking the most violent monthly price shock ever recorded in modern history. But the numbers on a screen only tell half the story. Behind the scenes, physical reality was setting in, and it was creating a severe market asymmetry. By early April, a desperate scramble to secure immediately available physical oil barrels forced the spot price to trade nearly $30 higher than the futures contract price. This massive valuation gap reveals a market in a state of absolute, undeniable short-term panic. Buyers were willingly, even desperately, overpaying for immediate physical delivery right this second, rather than gambling their economies on futures contracts that might never arrive. They weren't looking at charts, they were looking at empty domestic storage tanks and panicking. And out in the Middle East, a completely different, inverted crisis was unfolding. Government energy assessments revealed a staggering reality by May. Producers in the Middle East were forced to completely halt an average of 10.5 million barrels of daily production simply because their local storage tanks had reached their maximum absolute limits. This represents an unprecedented wipeout of global energy supplies. You can't just pause an entire region's oil infrastructure without breaking things. When regional land storage hits maximum capacity, producers are forced to execute what the industry calls shut-ins. They literally have to cap the wells. And this creates a massive global deficit that alternative sources, like United States shale production, simply cannot fix overnight, because those alternative operations require months of lead time just to marginally expand their output. The Western world was suddenly starving for energy, while the Gulf was quite literally drowning in it. But oil isn't the only critical resource caught in the crossfire. This geographical breakdown highlights a terrifying regional vulnerability, showing that nations like Qatar and Bahrain depend on these specific disrupted pathways for 60% of their regional exposure, while Saudi Arabia and Oman remain exposed at 20%. This brings us to a silent incredibly overlooked infrastructure risk: the region's drinking water. Much of the Gulf relies heavily on desalination. This process is like running harsh, salty ocean water through a giant high-tech kitchen filter to remove all salt and impurities, turning it into pure water that is perfectly safe for drinking and farming. But here is the catch. Desalination requires an absolutely massive, continuous amount of energy to operate. If the supply chains freeze and the domestic power grid falters, you aren't just looking at a financial crisis. You are looking at a regional water crisis that could cascade into an agricultural collapse. And as the West scrambled to manage this multi-layered catastrophe, something incredibly sophisticated was happening in the East. A quiet, highly strategic geopolitical maneuver was taking place right under the nose of Western regulators. For months, Western analysts had been pointing to a steep decline in the Chinese currency's share of international SWIFT payments as definitive proof that global interest in the RMB was cooling down. But they were looking at the wrong data. The currency wasn't losing popularity, it was going undercover. Enter CIPS, the cross-border interbank payment system. CIPS operates like a private, direct express highway built specifically for the Chinese currency to travel between international banks, allowing transactions to entirely bypass traditional Western financial toll booths. This diverging trend line exposes the illusion, showing that while Chinese currency payments seemed to decline on Western tracking platforms, they were actually surging entirely in secret on their own independent network. Foreign policy experts began publishing warnings by early March, presenting hard evidence that this massive, unseen migration of money directly threatens to permanently weaken the impact and reach of United States financial sanctions. And the sheer scale of this hidden economy is breathtaking. This towering data point captures the true momentum of this alternative network, proving that the monthly average daily business volume skyrocketed to an absolute peak of over 920 billion RMB by March. This map pulls back the curtain on the core architecture, revealing over 100 direct partner banks firmly established across Asia, alongside dozens more quietly integrating their systems across Europe and Africa. Direct bank participants on this alternative messaging system surged by nearly 40%. They moved massive transaction volumes entirely off Western monitoring networks. This isn't just a workaround, it is a fully functional, parallel financial universe operating in real time. When you connect all these dots, the big picture becomes incredibly clear and deeply concerning for the average consumer. Because geopolitics always, eventually, trickles down to your local grocery store. By late April, international development authorities were projecting that the cost of global raw materials would surge by 16% this year, entirely driven by these shattered supply lines, with energy and fertilizer markets expected to jump 24% and 31%, respectively. That 31% spike in fertilizer is the silent killer for the middle class. Fertilizer production is highly dependent on natural gas. This violent upward trajectory illustrates a massive surge in natural gas costs, a direct result of frantic European and Asian nations bidding fiercely against each other for whatever alternative fuel wasn't trapped in the Middle East. When natural gas prices skyrocket, fertilizer plants are forced to shut down because it becomes too expensive to produce ammonia. When fertilizer production drops, global crop yields plummet. And when crop yields plummet, the price of a loaf of bread, a gallon of milk, and a pound of beef at your local supermarket goes through the roof. We are looking at an environment that guarantees persistent, unavoidable pain at the pump, aggressively higher utility costs, and severe domestic food inflation. If crude oil continues trading above $100 a barrel for an extended period, macroeconomic models suggest up to 45 million additional people globally could be pushed into acute food insecurity, all while emerging market GDP growth gets severely slashed. But how are different parts of the world absorbing this massive shock? Let's look east again. Looking at this vast web of secondary connections, we see over 1,000 indirect banking partners fully operational across Asia, proving this rival financial plumbing is already deeply embedded and shielding its users from Western financial fallout. Despite facing multiple cascading global shocks, international monetary officials verified that the Chinese economy successfully maintained a resilient 5% growth rate last year, heavily padded by aggressive policy stimulus and robust exports. But that resilience is a carefully engineered facade, masking some severe domestic vulnerabilities. This sharp acceleration in the data directly maps the aggressive escalation of effective import taxes between Washington and Beijing, highlighting a fierce economic standoff that occurred just before a temporary diplomatic truce. To survive these tariffs and the energy shock, China had to rely entirely on selling its goods to the rest of the world. This dominant upward bar clearly demonstrates that a massive wave of overseas sales became the ultimate lifeline for their economic growth, acting as a critical buffer to completely offset the lackluster spending of their own domestic consumers. And why aren't their domestic consumers spending? Because their wealth is tied up in a collapsing real estate market. This relentless downward slope exposes a deep and painful contraction in their domestic property sector, with new construction prices across major metropolitan tiers trapped in a persistent, suffocating decline. This overwhelming concentration of data reveals a systemic internal vulnerability, showing that a massive majority of private corporate developers are currently operating under extreme financial distress, weighed down heavily by deeply depressed bond prices. So, we have a global economy split in two, a Western system fighting brutal, energy-driven inflation and supply chain blockades, and an Eastern system battling a domestic real estate crisis, but insulating its international trade by moving entirely onto a hidden, sanction-proof banking highway. And right in the middle of this massive power shift, unexpected players are stepping into the void. Shifting geopolitical winds allowed producers, like Venezuela, to suddenly rebound to a 7-year production high, actively rushing in to pump over 1 million barrels a day following the strategic lifting of US sanctions, desperately trying to fill the massive gap left by the Middle East. But even with these emergency interventions, the baseline reality remains incredibly strained. Even as we step into early June, global benchmarks remain fiercely elevated, near $95 a barrel, proving that the lingering fallout from these regional hostilities has fundamentally and permanently rewired the baseline cost of global energy. The era of cheap, easily accessible energy, built on a unified, dollar-dominated financial system, is rapidly fracturing. We are witnessing the real-time bifurcation of the global economy. When 20% of the world's seaborne oil supply gets blocked, it doesn't just raise the price of gas, it forces entire nations to rewrite the rules of international trade, effectively ending the absolute monopoly of the petrodollar system. The VIP pass has been handed out, the parallel banking highways are fully operational, and the structural costs of manufacturing, farming, and shipping have been reset to a much higher floor. The macro landscape has completely shifted, and the financial strategies that worked for the last 10 years are no longer going to protect you in the next 10. Understanding these invisible currents is the first step to securing your own wealth.